These are the warning signs economists say point to a market crash in late 2026 that could make 1929 and 2008 look like minor corrections. The national debt has hit 100% of GDP. Market valuations have reached historic extremes, and Warren Buffett sits on nearly $400 billion in cash. The pieces are falling into place for what some analysts are calling the worst financial collapse in American history. The numbers tell a story that should terrify anyone who lived through previous crashes. The Shiller price-to-earnings ratio stands at 40.5, marking only the second time in market history it's reached this level. In 155 years, this ratio topped 40 just 3 times, and the previous 2 ended in devastating bear markets. Meanwhile, the Buffett Indicator sits at 221%, well above the 200% level that Buffett himself warned in 2001 meant you're playing with fire. But this goes beyond expensive stocks. The entire financial system shows stress fractures that dwarf anything we saw before the previous 2 great crashes. Harry Dent, founder of H.S. Dent investment firm, has studied market cycles for decades, and his assessment is chilling. This bubble is different because it started in 2009 right out of the gates, didn't let a recession, finish cleansing debt, and just kept going. He's predicting a 90% decline in stock prices, calling it the worst market conditions since the Great Depression. To understand why 2026 could be worse than 1929, we need to examine what made that crash so devastating. In August 1921, the Dow Jones sat at just 63 points. By September 1929, it had rocketed to 381, a 6-fold increase that created the illusion of permanent prosperity. Irving Fisher, one of the nation's most respected economists, epitomized this false confidence when he declared that stock prices had reached what looks like a permanently high plateau. Within 2 weeks, the market began its spectacular collapse. The crash unfolded in terrifying stages. Black Thursday arrived on October 24th, followed by Black Monday and Black Tuesday on October 28th and 29th. The market dropped nearly 25% in just those few days. By mid-November, the Dow had lost almost half its value, and the slide continued relentlessly through the summer of 1932, when it closed at 41.22, an 89% decline from its peak. Most shocking of all, the Dow didn't return to its 1929 levels until November 1954, a full 25 years later. The 2008 financial crisis followed a similar pattern, but with different triggers. On September 15, 2008, Lehman Brothers filed for bankruptcy, while Merrill Lynch collapsed, and AIG faced a liquidity crisis, all primarily due to exposure to subprime mortgages and credit derivatives. The contagion spread globally within days. From October 6 to 10th, the Dow closed lower in all 5 sessions, falling over 1,874 points or 18% in its worst weekly decline ever. Yet even with its global scope, 2008 pales in comparison to what economists are predicting for 2026. Peter Schiff, economist at Euro-Pacific Asset Management, puts it bluntly: we're headed for an economic crisis that will make the 2008 financial crisis look like a Sunday school picnic. His reasoning centers on a fundamental difference. The main difference between the 2026 financial crisis and the 2008 financial crisis, other than the fact that this one will be much worse, is that it won't be global. It's going to be an American financial crisis. This distinction matters enormously. In 2008, the crisis originated in the United States, but other economies remained relatively stable, providing a foundation for eventual recovery. This time, Schiff argues, America's problems stem from its unsustainable debt burden and the dollar's weakening reserve currency status. We have a dysfunctional consumer-based credit economy that rests on the foundation of the US dollar's reserve currency status, and the world is now pulling the rug out from under the US. The debt numbers support Schiff's concerns. The national debt has reached nearly $39 trillion and continues climbing toward $40 trillion by year's end. We're borrowing $602 billion already this fiscal year, with $145 billion added in December alone, putting us on course for a nearly $2 trillion deficit. Interest costs on this debt surged to roughly $1 trillion last year, consuming 18% of federal revenue, an amount comparable to the entire Medicare budget. The Committee for a Responsible Federal Budget warns that this trajectory could trigger 6 distinct types of fiscal crises: a financial crisis, an inflation crisis, an austerity crisis, a currency crisis, a default crisis, or a gradual crisis. If the national debt continues to grow faster than the economy, the country could ultimately experience some combination of crises. Ray Dalio, founder of Bridgewater Associates, frames this in even starker terms. Speaking at the World Government Summit in Dubai in February 2026, Dalio warned that we're dealing with the breakdown of the monetary order. He described America as being on course for a debt-death spiral and painted a grim picture of intergenerational theft. My grandchildren and great-grandchildren not yet born are going to be paying off this debt in devalued dollars. But Dalio's most ominous warning concerns what he calls a capital war, economic warfare where countries attack each other by controlling money flows rather than through military force. We are on the brink, he said, in February 2026. That means not in, but it means we are quite close to a capital war, because there are mutual fears. Evidence of this capital war is already emerging. For the first time in nearly 30 years, global central banks now hold more gold than U.S. treasuries. Data from late 2025 shows central banks holding approximately 36,000 metric tons of gold, valued around $4.5 trillion, compared to $3.5 trillion in U.S. treasuries. Since April 2025, foreign central banks have reduced their U.S. treasury exposure by approximately $183 billion, reallocating funds into gold. The implications extend far beyond government finance. Today's market concentration creates unprecedented systemic risk. The top 7 stocks in the S&P 500 account for over 30% of the index, sometimes approaching 35%. This means buying a large cap index fund today essentially amounts to a leveraged bet on a handful of technology companies. This concentration dwarfs anything seen before previous crashes. Warren Buffett, often called the Oracle of Omaha, Machin appears to be preparing for exactly this scenario. For 12 consecutive quarters, something he's never done before in his career, Buffett has sold more stocks than he bought. Berkshire Hathaway's cash holdings have ballooned from $100 billion to nearly $400 billion, with most proceeds coming from selling Apple stock. For an investor famous for buying and holding forever, this represents an unprecedented warning signal. Buffett's cash hoarding reflects his belief that the market has become dangerously overvalued. The S&P 500 currently trades at 22.2 times forward earnings, according to FactSet Research. The index has only sustained a forward price-to-earnings ratio above 22 during 2 periods in the past 40 years. The dot-com bubble and the COVID-19 pandemic. Both situations led to bear markets. The artificial intelligence bubble adds another layer of concern. OpenAI, whose ChatGPT launch triggered the current AI frenzy, plans to spend a jaw-dropping $1.4 trillion on computing resources over the next 8 years. With only $20 billion in annualized revenue, the math simply doesn't work. Fidelity warns of a disconnect between the positive short-term environment for risk assets and a broader structural instability related to AI capital expenditure trends. Institutional investors are taking notice. A survey of institutions controlling $30 trillion found that 79% anticipate a market decline, with 49% predicting drops of 10 to 20%. This represents smart money positioning for trouble while retail investors continue pouring money into commission-free trading platforms and retirement accounts, a classic precondition for major crashes. And the Federal Reserve finds itself in an impossible position. When Paul Volcker raised interest rates in the 1980s to combat inflation, national debt was only about 25% of GDP. Today, with debt at 100% of GDP, the sheer magnitude means any significant rate increases would trigger immediate fiscal crisis. Fed Chairman Jerome Powell acknowledged this constraint in September, warning that by many measures, equity prices are fairly highly valued, while Fed Governor Lisa Cook said she would not be surprised by outsized asset price declines. Early warning signs are already appearing. In February 2026, the S&P 500 fell 2.6% following a sharp tech sector sell-off, while cryptocurrency markets plunged for 3 consecutive sessions, with $775 million in leveraged positions liquidated. These may seem like normal market volatility, but they echo the initial tremors that preceded previous collapses. The timing concerns many analysts. Goldman Sachs estimates a 35% chance of recession in 2026, while the current unemployment rate remains relatively stable at 4.4%. This disconnect between seemingly healthy employment and building financial pressures mirrors conditions before both 1929 and 2008, when surface stability masked underlying rot. Jamie Dimon, CEO of JPMorgan Chase, has warned that more cockroaches may be emerging regarding credit concerns. His bank has seen firsthand how quickly financial contagion can spread, and his caution reflects growing awareness among banking executives that the current system's stability is largely illusory. What makes the potential 2026 crash uniquely dangerous is the convergence of multiple bubbles simultaneously. Unlike 1929, which was primarily a stock market bubble, or 2008, which centered on real estate and derivatives, today's bubble encompasses equities, real estate, cryptocurrencies, and government debt all at once. Harry Dent calls this a super bubble that rejects the notion that speculation is limited to any single asset class. The international dimension adds another complication. Mamadou Kwijim Mtura notes that de-dollarization is accelerating. In 2000, the dollar accounted for roughly 70% of global foreign exchange reserves, but by the third quarter of 2025, its share had fallen to 56.92%. This erosion of dollar dominance removes a crucial safety valve that helped America weather previous crises. Perhaps most concerning is the duration of the current bubble. Previous bubbles typically lasted 3 to 5 years before bursting. The current bubble began in 2009 and has been inflating for 17 years, fed by unprecedented monetary stimulus and near zero interest rates. This extended timeline has allowed imbalances to reach levels that would have triggered corrections years ago under normal circumstances. The evidence suggests we're not just facing another market correction, or even a typical recession. Multiple indicators point toward a systemic breakdown that could reshape the American economy and the global financial order. With valuations at historic extremes, debt at unsustainable levels, and smart money heading for the exits, the stage is set for the kind of collapse that defines generations. The only question remaining is whether policymakers and investors will heed these warning signs, or, like Irving Fisher in 1929, convince themselves that this time is different. History suggests the outcome is already determined. The only uncertainty is the precise timing and magnitude of what economists increasingly see as an inevitable reckoning.